Okay, hello guys. For today, we are going to talk about the long-term construction by percentage of completion, the POC method. This method is appropriate to use the percentage of completion when collection is assured and the entity's accounting system can reasonably estimate the profitability and provide a reliable measure of progress toward completion. So the estimates of progress toward completion, revenues, and costs are reasonably dependable. The contract clearly specifies the enforceable rights regarding goods or services to be provided and received by the contract parties, and the consideration to the exchanges to be exchanged, and the manner and terms of settlement. So the buyer can be expected to satisfy all obligations under the contract. The contractor can be expected to perform the contractual obligation. So let's start this exercise based on the long-term construction by POC method. Contracts and billing and collection information through year 1 and to year 3. 3 years long-term construction contract for $450,000 billing, 90,000 and received 75,000 on year 1 and billing amount year 2 and received year 2 and billing amount and received amount year 3. So before jumping into journal entry transaction each year and reporting in the financial statements, we need to create the schedule of POC and revenue, cost, profit, and CIP each year to facilitate this procedure. So as you can see, the actual total cost to date, that is the cumulative from the start of the construction. And estimated total cost is the total cost to completion until the completion. So it can be changing. Like this 400,000 and 405,000 increased. It can be changing under the real life. For example, when the material cost has been increased, so this total cost can change, right? And then the percentage of the completion that we want to calculate in percentage of the cost, and then the revenue of the year. Each year, the revenue, cost, the profit is not a cumulative. That is the year-based amount. Construction progress of the year as well. But the point is that this percentage of completion is not the year base. That is the cumulative. Why? Because we take all this information from the cumulative information of the cost spending. So let's start. So first, the percentage of completion is 100,000 divided by 400. So 25% is completed from the start of the construction. And then the revenue of the year. How do you get this revenue of the year? That's correct. $450,000 is contract amount, and times, that's right, we finish it 25%. 25% we finish it this project. So the revenue we can recognize is 120,500. So the point of this long-term construction by percentage of completion is that the gap allows the company to recognize revenue along with the completion of this long-term project. That's why it is reliable. It is relevant. This is relevant based on the matching principle under gap. And then cost of the year. How much is cost? Right, that is the actual cost. So 100,000. And the profit is very easy. Revenue minus cost. And then construction in progress of the year. Okay, the point is the inventory value the company can recognize is the same as the cost plus profit. Cost plus profit. And then it's gonna be converted to the revenue as well, because the cost of profit plus profit is also the same as the revenue. So we can just simply use the revenue of the year. So that is the construction in progress of that year, right? And then let's put that schedule into the journal entry. So construction in progress is 112,500, exactly same value as the revenue the company made of that year. And then we need to consider cost of goods sold. Why we need to consider cost of goods sold even though the company didn't finish the completion of this construction? Because we recognize the revenue based on the matching principle. Now we can recognize costs. By doing so, we also can come up with the profit of the year. Okay, so the cost of goods sold is the same as which one? That's right, the cost. Then we needed to recognize cash out. That the cash out, this 100 or this cost is the spending amount the company actually expensed for the construction during only that period of year one. So the cash exactly same this. And then we also have a billing information. So that is the long-term project, long-term construction project. So the company can send the billing to the buyer, the every period. So here put the billings first here. How much was the billing? That's right, on the first year, the 90,000. Why do you put this billing on the credit side? Because it's a liability? No, the billing is not a liability. Or equity? No, that is the contra account, as we discussed in the classroom. That is the contra account that reduces the inventory, the CIP. Once we build, then we assume that inventory goes out. So the inventory, in order to reduce the value of the inventory, so the billing account is the contra account that reduces the inventory value. So billing is the contra account of asset, which is inventory. So we put the billing here. And then we haven't received when we bill. How much is the AR? Is that correct? It's 90,000. And then how much we received cash? We received 75,000, right? So 75,000. By that amount, by this amount, we can reduce 75. So let's report this transaction in the balance sheet and income statement. Cash. How much is cash? Right, the cash out 100,000, cash in 75,000. Let's assume there's no negative account on the main account on the income statement, by the way. But just assume that we have had the cash amount, but we want to just focus on this transaction today. So the cash amount is minus 100 because the cash out on the credit side plus cash in 75. So that's correct. And then AR, how do you get the AR? Okay, here we go. Starting from 90,000 minus 75,000. And then CIP inventory. There we go. The construction in progress. And then less billing, that is contra account. So negative value of $90,000. Okay, then let's recognize the revenue based on the matching principle and accounting principle of the relevance. So the revenue 112,500, and then cost of goods sold, so that the net income is, let's just sum up this two. Then the retained earning is a net income at the first year, so we matched out. Okay, then let's jump into the year two. Year two, what is the percentage of completion? Percentage of completion is 72%. The company completed this construction to the date of the end of year two. So for 2 years, they completed 72%. But the point is that the revenue of the year, we are not using based on this contract times 72%. No, because that is the revenue only for that year. If we use this, that is not the revenue of the year two. That is the revenue cumulative year 1 and 2. We are not using this amount, okay? When we record this into the income statement, because income statement is the amount of for the year end, only 1 year. That's why we need to subtract the revenue of previous year, okay? Then the cost also, that cost is the total cost to the date for 2 years. So we need to extract only 1 year actual cost to date of that year. So the expense, the cost is 191,600. So the revenue minus the cost is 19,900. That is the construction in progress. That is the profit. And then how do you get the construction profit? Right, cost plus profit. That is the value of the inventory. Value of the inventory of that year. Or you can get the revenue exactly same, right? Then let's put this one into the journal entry and the balance sheet and income statement. We're gonna use the same account. So let's just copy and paste, because we are going to use the same account with different amount. So the CIP, how much is the CIP? That is the 1 year of the year. So that's correct, 211,500. Then what is the revenue we recognized here? It's the same amount, and then cost of goods sold is that year cost. And then cash amount is that amount. So the cost amount is the same. And then AR, how much is AR? Now AR, we have another information on year two. Here, billing 200,000, received 172 on year two. So the billing and AR 200,000. Billing is contra account that reduced the inventory value. We assuming that the inventory that goes out, right? So that reduced when we bill. That means the inventory goes out. So we reduce the inventory value. So the billing account is contra account of an asset. Now the cash the company received is $175,000. Then when the company received the cash, AR reduced. So let's put this information here. But remember, you have to do before putting this journal entry into the balance sheet and income statement. You have to start from the prior year balance, prior year ending balance. Why? Because the balance sheet is the cumulative starting from the business to end. So we're starting from exactly the same as the ending balance of the year one. Okay, then let's put first, let's find the cash balance. Here you go. So this plus, minus cash plus cash amount we received. So cash amount now 41,600. What about AR? AR we have plus 200,000 when we bill, and then when received, which is negative $107,000. So the AR now is $40,000 on the balance sheet. And then CIP inventory we recognize here. That's correct, this amount. And less billing we billed, right, 200,000. So total is 32,400. What about inventory account revenue and cost of goods sold? Oh, here. Then the net income. Now we got 99,900, which is the same as 99,000 here, profit of the year. But the point is that the retained earning also is a sum of all the net income, right? Net income. That's why we don't have the balance out between total asset and total liability and equity. So that should be added from the year 2 net income. So we complete it. Okay. Then finally, the third year completion done, right? The revenue of the year is now 450,000. Contract times 100. I know that is not necessary to do, but anyway, that's 100% minus prior year revenue, prior revenues, because we want to just extract the revenue amount only on that year of third year, right? So 126 is the revenue, and then equal cost of that year. How much is the cost of that year? That's correct. So that is the total cost. Now we want the minus. That is cumulative. You don't have to subtract this amount because that is the cumulative actual total cost to the date. Okay, so we got 113,400, and then profit of the year. Then construction in progress is the same as the revenue, which is cost plus a profit of that year. Now let's put this onto here. I'm gonna use the same name of the balance, but different amount. Okay, the CIP of the third year is, here we go, 126,000. Then the revenue, where was the revenue? The same amount of the CIP. Then cost of goods sold is the cost of that year, and then the cash balance out exactly the same as cost of goods sold, because the company assumed that they spend this cost of goods sold on the third year. Then AR, how much was the AR on the third year? On the third year, 160,000, and received $200,000, so 160,000. So the billing should be recognized when they send the bills. So the same amount as AR, and then cash amount they receive 200,000. By this amount, they have to reduce AR. I guess this total amount of AR 160, 200,000, and 9,000 should be same as the 450, which is the same price of the contract. Okay. Now again, one more time, we need to start from here, right? Exactly the prior year's balance of the information, because in the balance sheet is this is the cumulative, right? Cumulative. So let's just start from then on. Exactly same value as the ending balance of prior year. So here, let's start cash. We subtract the cash out for the cost of inventory. And then we receive 200,000. So the cash balance at the end of 3 is 45,000. And then AR that we received, the AR we recognize plus 160 minus, that is what we received, 200,000. So we don't have any AR because we receive all the cash of the accounts receivable. And the CIP, now let's starting from this point, plus 126. So do you see exactly the same value of the contract, same value as the contract, and less billings, the final billing, minus 106, that is the final billing. So it should be exactly also same as AR. We have recalled AR is equal to billing. Once we send the company sends the billing out to the buyer, which is the same as the AR, also same as this contract price, right? So we got it. The total asset is 45,000, the cash amount, which is the sum of the sum of this, the profit. Now let's put the income statement account starting from revenue minus cost of goods sold, and then net income is this too. So 12,600, exactly same as profit of the year based on the POC. So we need to update this retained earning by adding the net income. So we completed total asset is equal to the total liability and equity. Okay, that's it.